Everyone loves a good success story, especially in venture capital, Uber, Airbnb, Stripe. But for every unicorn, there are dozens of silent failures. Want to know what they don't tell you about venture investing? Let's dive into the real risks before your money disappears into the startup abyss. Before we unpack these risks, don't forget to hit that subscribe button. We publish weekly videos that make you smarter with your money, so you can build wealth without falling into hype traps. 1. Illiquidity risk. What it means: when you invest in a venture capital (VC) fund, your money is committed for a long period, usually 7 to 10 years or more. These funds don't allow early withdrawals like mutual funds or stocks. Why it matters? You lose flexibility. You must plan around the idea that you won't see your capital or returns for nearly a decade. Emergencies or better opportunities may arise, but your cash is locked up. Real-world example. An investor commits $50,000 in a VC fund in 2020. By 2028, only one of 10 portfolio companies has had an exit. No distributions have been made. 2. Lack of transparency. What it means: unlike public companies, startups aren't required to publish audited financials. Fund managers may provide updates, but they're often infrequent and vague. Why it matters? Investors can't track performance in real time. You depend entirely on fund managers for updates. Startup valuations may be arbitrary or inflated. Real-world example. A fund reports a 2.5x markup on a startup valuation, but no one else is investing at that level. The startup later shuts down with no exit. 3. High failure rate. What it means: most startups fail. In fact, 70 to 90% of startups shut down within a few years. Why it matters? The fund may rely on a single unicorn to deliver the bulk of returns. Even a great idea can fail due to bad timing, execution, or competition. Real-world example. A health tech startup raises $10 million from a VC fund, but runs out of cash after 2 years due to regulatory hurdles and poor user adoption. 4. Valuation traps. What it means: startups often raise capital at increasing valuations, called up rounds. But those figures are not based on market liquidity. They're based on what another investor agrees to pay. Why it matters? On paper, it looks like your investment is growing. In reality, these paper profits may never convert to real gains. Down rounds and liquidation preferences can wipe you out. Real-world example. A startup raises a Series C at $500 million valuation. It fails to raise more funds, exits at $100 million, and investors in earlier rounds get nothing after debts and preferences are paid. 5. Limited access and selection bias. What it means: top-performing VC funds, like Sequoia or Andreessen Horowitz, are often closed to retail investors. What's available publicly are often less experienced funds or newer firms. Why it matters? Access doesn't equal quality. Most retail-accessible funds don't outperform. You may unknowingly invest in unproven or high-risk portfolios. Real-world example. A crowdfunding VC platform offers access to a new-age tech fund, but the fund manager has never had a startup exit. Returns underperform. 6. High fees. What it means: typical VC fee structures are 2 and 20. 2% annual management fee plus 20% of all profits, carried interest. Why it matters? Fees compound over time, especially in long-dated funds. If your fund barely outperforms, fees can erase most of your gains. Fund managers get paid even if you don't make a profit. Real-world example. In a $100,000 investment, you pay $2,000 per year in fees regardless of fund performance. If the fund underperforms, you still lose money while the manager profits. 7. Market timing and exit risks. What it means: startups must exit, either through IPOs, acquisitions, or secondary sales, for investors to earn a return. These exits depend on broader market conditions. Why it matters: great startups may delay exits in a bad economy. Exits might happen below expected valuations. Your returns can be delayed for years or disappear entirely. Real-world example: a promising fintech startup delays its IPO due to high interest rates and inflation. It burns capital and downsizes, hurting valuation. 8. How to protect yourself. What to do: diversify across asset classes. Venture funds should only be a small portion of your portfolio. Choose managers with a proven track record. Understand the investment thesis, sector, geography, stage focus, etc. Look into secondary market options in case you need liquidity later. Bonus tip: ask for reference exits, fee disclosures, and historical IRR, internal rate of return, when assessing a fund.